Welcome back to the Wall Street Podcast.
Great to be here.
Today, we're doing a deep dive into a really interesting analysis. It's from Zion Research Group.
That's right. It formed the basis for a Wall Street Journal piece just this Tuesday, August 5th.
And it digs into the cash tax savings big U.S. companies are seeing.
Yes, specifically from the One Big Beautiful Bill Act, the federal tax legislation.
We want to look at the impact, immediate and maybe longer term on corporate finance, the market.
Exactly. And the report really highlights a significant financial shift.
How significant are we talking? What are the headline numbers?
Zion Research Group estimates about $148 billion in total cash tax savings.
$148 billion.
Just for their sample, which was 369 S&P 500 companies.
Okay. And how does that compare, say, to their cash flow?
Well, it works out to about 8.5% of their combined full-year free cash flow estimate.
8.5%. That's substantial.
It is. And free cash flow, just as a quick reminder for you listening, that's the cash left after covering operations and big investments, the money available, really.
Right, for paying down debt, buybacks, reinvestment. And it's not spread evenly, I gather.
No, definitely not. Some of the tech giants are seeing, huge benefits.
Thank you.
Amazon, Meta Platforms, Alphabet, and Microsoft. Between them, they account for 38% of that total, $148 billion.
38% just from 4 companies.
Yeah.
Wow. Any specific numbers?
Yeah, for Amazon, the estimate is $15.7 billion in cash tax savings.
$15.7 billion. How does that stack up against their free cash flow?
It's massive.
Oh.
43% of their average analyst estimate for 2025 free cash flow.
43%. Okay. And Meta?
Meta Platforms could see savings up to $11 billion. That's about 31% of their previously estimated free cash flow for the year.
It's a really significant boost for them. Is it just tech?
Not entirely. AT&T is another example. They expect maybe $1.5 to $2 billion in savings this year.
Okay, still a big number.
And that could boost their free cash flow estimates by around 11%. Plus, they're forecasting more.
More savings later.
Yes, annual savings of maybe $2.5 to $3 billion in 2026 and 2027. So it's recurring for them.
Interesting. So how exactly are these savings happening? What's in the act?
It's mainly 2 things. First, upfront depreciation of assets.
Meaning they can deduct investment costs faster.
Exactly. Bigger deductions right away instead of spreading them out. And second, immediate expensing for R&D.
Research and development.
Right. Every dollar spent on R&D can immediately cut their taxable income. It's a direct incentive.
Okay, so depreciation and R&D. That clarifies the mechanics. Let's circle back to the scale then. You gave the overall $148 billion. But for these key players, just reiterate the immediate impact.
Sure. For Amazon, it's that 43% free cash flow boost.
Mm-hmm.
For Meta, 31%. Huge percentages.
And AT&T looking at recurring billions.
Precisely. It's like finding extra capital on the balance sheet, effectively.
So with all this extra cash, this windfall, how might that change what companies decide to do strategically?
Well, some, like AT&T mentioned, plan to reinvest a lot of it. Capital projects, infrastructure.
Makes sense. What else?
It gives them options. Reducing debt is a big one for some companies. Or stock buybacks, returning cash to shareholders.
Which investors generally like to see.
Theoretically, yes. It's, more cash staying with the company and less going to Uncle Sam. That can support valuations.
Right. Now, thinking broader than just the companies themselves, what signals do these tax changes send to the wider economy, to the market?
The report calls it incremental fuel for the stock market.
Incremental fuel.
Yeah, it helps offset other worries like maybe tariffs or policy uncertainty. It provides a boost.
And we saw markets react recently.
We did. On Monday, August 4th, you saw the major indexes jump over 1%. Biggest daily gain since May, actually. These savings were likely a contributing factor to that positive sentiment.
So bolsters confidence.
Yeah.
How does this filter down to, say, the average person listening? Someone maybe not directly trading stocks day to day.
Well, the boost to corporate free cash flow and the resulting market strength does have indirect effects.
How so?
For anyone with, say, a 401k or other investments, a stronger market generally supports the value of those portfolios. It builds investor confidence.
And potentially encourages companies to invest more, maybe create jobs.
That's the idea. Increased corporate investment driven by these savings could contribute to broader economic stability and growth, which ultimately benefits everyone.
Okay, that connects the dots. So as we wrap up, thinking about this large, concentrated injection of capital into corporations through tax law, it really makes you wonder, doesn't it?
It does raise some questions.
Here's something for you to consider. Does this signal a new era of fiscal policy? Could it be reshaping economic priorities, changing how wealth flows in the years ahead?